Gold just broke containment. While the rest of the world was distracted by tech stocks and political noise, the yellow metal jumped the fence, pushing into territory that shouldn't exist if the economy was truly stable. But here is the strange part. Silver didn't move. It sat there. It flinched. It looked like it was asleep. And for most casual investors, that silence looks like weakness. They look at the chart and see a dead asset. But they are making a critical error. They are mistaking potential energy for a lack of interest. What we are witnessing right now isn't a failure of silver to launch. It is the tension before the snap. Silver is the fast horse tied to a much bigger, slower animal. When the big animal, gold, starts to run, the fast horse doesn't just trot along beside it. It gets dragged, then it finds its footing, and then it bolts. But here is the secret that Wall Street doesn't want you to panic over. By the time silver starts acting like a fast horse, the entry doors are already welded shut. The biggest gains don't happen when the story is on the news. They happen in the quiet moments when the pressure is building underground. But it gets more volatile. You have to understand the physics of this trade to understand the violence of the move that is coming. Imagine gold as a massive football stadium filled with people. If $1 billion enters that stadium, it spreads out, and nobody really notices. Now imagine silver is a tiny, cramped room next door. If that same $1 billion tries to squeeze into the small room, the walls blow out. The windows shatter. The pressure becomes unmanageable instantly. This isn't just a metaphor, it is market math. There are individual tech companies in the stock market right now that are worth more than all the investable silver on the planet combined. Think about that. So when capital decides to rotate, when the big money gets scared of the dollar and looks for a hiding spot, it doesn't need the whole world to buy silver. It only takes a handful of billionaires or a single sovereign fund to panic buy, and the price doesn't just tick up, it teleports. This is why we call silver fast gold. Gold moves like a gentleman. Silver moves like a fist fight in a crowded bar. However, there is a trap waiting for you, and it is hidden in the supply numbers. If you Google how much silver is in the world, you will get a massive number. You will hear about tons of metal sitting in the ground, in jewelry, or in your grandmother's antique cutlery. The skeptics will tell you there is too much supply for a price squeeze. They are lying to you, not about the existence of the metal, but about its availability. Price is not set by what exists. Price is set by what is for sale today. This is called the free float. Most of the world's silver is trapped. It is locked in landfills, soldered into circuit boards, or buried in vaults that haven't opened in decades. Even if the price doubled tomorrow, that silver cannot hit the market instantly. It takes months to collect, melt, refine, and mint. That time delay is the kill zone. When demand spikes vertically, the supply pipeline is too slow to react. That friction is where the price goes from rational to absolute mania. And that is exactly where the smart money plans to sell to the desperate money. Now we need to look at the darker reason why this is happening. We have to talk about the war insurance trade. The media keeps trying to tell you that gold and silver are moving because of inflation or interest rates. That is only half the story. The real driver is something much colder. Look at who is buying. It's central banks. It's nations that don't trust each other anymore. Gold and silver are what you hold when you think the phone lines might get cut. It is what you stack when you are worried that your foreign contracts might be torn up. This is a shift in global posture. Governments are preparing for a world where sanctions expand and supply chains shatter. They are building a buffer. And unlike a day trader who panics when the chart dips, these buyers do not care about the price. They care about possession. They are removing physical metal from the market to stick it in a deep vault for the next 30 years. This removes the floor from under the short sellers. You can fight a retail crowd, but you cannot fight a sovereign nation that needs strategic reserves for its industrial military stack. So, where does this leave us? It brings us to the most dangerous number in the world, $100. $100 silver is not just a price target. It is a psychological cliff. Humans don't trade math, they trade stories. And $100 is a story you can hear from across the room. It's a nice, round, perfect number, and that is why it is the Widowmaker. When an asset approaches a number like that, logic leaves the building. The headlines will scream $200 is next. Your neighbor, your barber, and your group chat will all suddenly become silver experts. That is the signal. That is the moment the smart money hands the bag to the late money. The euphoria you feel at that moment is not confirmation. It is the sound of the exit door closing. Tops are not formed by selling. They are formed by exhaustion. They happen when the last buyer has finally bought and there is nobody left to push the price higher. This leads us to the only rule that matters if you want to survive this. You need to strip away your ego before the market does it for you. We use a specific mental test to keep our heads on straight when the charts go vertical. It's simple, but it hurts. Imagine you wake up tomorrow morning, and due to a glitch, your broker has accidentally sold your entire silver position. You are sitting in cash. The price is the same. The chart is the same. The news is the same. Do you immediately buy it all back? If your answer is a hesitation or a no, then you are holding a position you don't actually believe in. You are just gambling on momentum. You are suffering from the endowment effect, valuing something just because you already own it. If you wouldn't buy it today at this price, you shouldn't be holding it today at this price. This test forces you into the present moment. It kills the emotional attachment to the trade. We are heading into a period where the market will likely try to shake you out. Silver rises like a staircase during an earthquake. It goes up 2 steps, crashes down 1 step, and then jumps 3 steps while you are terrified to look. That volatility is the price of admission. If you can't handle a 20% drop in a week, you are oversized. You are trading with your rent money, not your capital. The script is flipping. For years, silver was boring. It was the dead money. Now, the engines are turning on. The industrial demand from AI and energy sectors is colliding with the monetary demand from paranoid governments. The fast horse is twitching at the gate. But remember this warning. When the gate finally opens, the crowd will stampede. Your job isn't to run with the crowd. Your job is to be standing at the finish line, waiting to sell your ticket to the guy who just showed up. The next few weeks are going to clarify everything. If gold holds its ground and keeps trending, the rubber band on silver is going to snap. Watch the relationship, not the noise. If gold is the general, silver is the soldier, and right now, the general is marching. The only question left is simple. Are you positioning yourself as the shark who eats the panic, or the fish who provides the liquidity? The choice is yours, but the time to make it is running out.